Welcome guys, this is RP Forex with another Forex lesson. Today we're talking about how to use risk management in Forex trading. And as you can see on the chart, we have quite a bit of numbers, and this isn't the norm for Forex, but I felt that was important to break down the numbers so you guys can understand the risk management protocol we take at Forex Lens. Now the example we're going to do is a $10,000 equity account, and what that means is there's either $10,000 in your balance or $5,000 in your balance and $5,000 in your credit, or any in combination that equals to $10,000 in equity. Now our guideline at Forex Lens for our signal service and trading room is to risk no more than 1 to 3% per trade. In our example, that's 100 to 300 per trade with an average of 200. I believe the 2% risk is the sweet spot. Now risk to reward, we all know what that is. Most of our signals and setups have a risk to reward greater than 2.0. For example, this setup here that we'll be calling as a signal has a risk to reward of 2.85, and what that means is the potential profit on this trade is 2.85 times the potential loss. Now let's do an example. Let's say 8 trades were called for the week and 6 are winners. That's around 75% accuracy. The net for that week will be 6 times the winning profit, which is 400, minus 2 times the losing amount, and that's 200, and that's a net of 2,000 for the week, and that's an increase of 20% on our $10,000 account. Now let's factor in noise of a degree of 0.15. And what noise is, let's say there's a news event happening, so you had to leave the trade early, so you didn't get all of the profit. Let's say you only got some of the profit, or let's say you had to close the trade early because you were heading to bed, so you only got this much of the profit. If we factor in that noise with the 0.15 degree, you'll see that 2,000 times 1 minus that noise is equal to 1,700, or a 17% increase on your account, which is still really good. If you take that into consideration, or over a 4-week span or within a month, you're looking at almost doubling your equity. So that's how we do things at Forex Lens. And if you look at the opposite of the approach, let's say we lose 5 trades in a row. If you're only risking 2% per trade, your account will only be down 1,000. Right? So 1,000 down from a $10,000 account is only a 10% decrease. So you can see how when you look for setups with a 2.0 risk reward or greater, it all works out in your favor, even if you're having a losing week. So that's how you use risk management in Forex, and those are the guidelines we take at Forex Lens. Thanks for watching.